Good afternoon. It's my pleasure to welcome you to another one of our discussions on whether or not the Federal Reserve has succeeded in producing a soft economic landing. And it's my particular pleasure to welcome our distinguished and experienced panel of experts. In the order in which they'll speak, they're Kevin Walsh, who was a former Federal Reserve governor, Don Cohen, who was a former chairman at the Fed, Bill White, a former senior official at the BIS and OECD, who also needs no introduction, and me, a former humble IMF official. The discussion will be moderated by my good friend and former colleague, Alex Pollock, who is now a senior fellow at the Mises Institute. I'm very much looking forward to hearing how our panel's views on the Fed might have evolved over the past year when we last met to discuss the subject. Now, it would be an understatement to say that since we met last October, a lot has happened in the US economy. Some of it has been very good. However, some of it raises questions about the economic outlook next year. So let me start with the good news. Contrary to what was widely expected among economists, so far the Fed has been very successful in making progress on the attainment of its dual mandate of price stability and maximum employment. Despite having raised interest rates over the past 18 months by as much as 525 basis points, the US economy has still managed to grow at a faster rate than those of its G7 partners, while the labor market has remained unusually strong. Unemployment has remained close to a 50-year low. At the same time, headline inflation has come down from over 9% in June 2022 to a little over 3.5% right now. And some progress has also been made in bringing down so-called core inflation. Further good news is that despite the Fed withdrawing very large amounts of market liquidity each month through its quantitative tightening policy, the stock market has managed to recoup most of the losses that it suffered last year, and now is less than 5% below its January 2022 peak. This stands in sharp contrast to the bond market, which, after having had its worst year on record in 2022, is down further this year. Let me now turn to a couple of items that could cloud next year's economic outlook. The first is that financial market strains have emerged in the wake of the Fed's aggressive monetary policy tightening. At the start of this year, a number of large regional banks failed and required Federal Reserve intervention. More recently, there have been continuing signs that commercial real estate companies will have trouble in repaying the large amounts of their debt that fall due next year. That will begin to surface. At the same time, the banks are nursing unusually large losses on their long-dated bond and lending portfolios. So the second cloud that now overhangs the US economic outlook is the deterioration in the external economy. It now appears that Germany has succumbed to recession, and the Chinese economy is in serious trouble in the wake of the bursting of its outsized property and credit market bubble. This has to be of concern, considering that China is the world's second largest economy, and until recently was the world's main engine of economic growth. So all of this raises a number of questions. What are the chances that the Fed will succeed in producing a soft economic landing? How appropriate has the Fed's interest rate policy been? Does the Fed need further interest rate increases to regain inflation control? Third, is the Fed paying sufficient attention to the strains that now appear to be emerging in the financial system? How much weight should the Fed be giving to external economic developments in general and to those in China in particular? A number of economists have been floating the idea that the Fed should be thinking of changing its inflation target. How much sense does that make? Lastly, how can the Fed respond to any future economic downturn without creating the asset and credit market bubbles that have characterized the last three economic cycles? So we have a whole bunch of questions to cover, and we're truly fortunate to have a panel of real experts who can shed light on these questions. So without further ado, let me hand it over to Alex to moderate the event. Alex, the floor is yours.
Thank you, Desmond, and congratulations on organizing another perfectly timed conference as we discuss whether the Fed has produced a soft landing. Everybody knows a soft landing is not easy to orchestrate. A long time ago, I was told this story, which still seems to me appropriate. The central bank trying to have a soft landing is like the pilot of a 747 where the windshield has been painted over so you can't see anything. You have to land on instruments, and the instruments only tell you where you were 15 minutes before. Now, I add to this story to make it more realistic. In addition to that, the airport itself is observing your motions and is reacting and moving in unexpected ways as you're trying to land on it. So we know the Fed is always faced with fundamental uncertainty in addressing these complex, interactive, recursive, adaptive, expectational systems, as Bill White has written so eloquently on. But in spite of the uncertainty, it has to do something anyway. It's often repeated that we need for a soft landing, getting inflation down to an acceptable level while not having a recession. But as Desmond just suggested, it seems to me there's a third essential requirement for a soft landing, is that you don't have a financial bust or a financial crisis. While you're at it, I will pose a couple of questions in each of these three things just by way of introduction. On inflation, 3.5%, it's better than 9%, as Desmond said, but it's still too high. At 3.5% inflation, prices double in 20 years, and in the course of a lifetime, multiply by 15 times. And that's a far cry from the stable prices which the Federal Reserve Act directs the Fed to pursue. And as Chairman Powell said yesterday, inflation still has to come down more. How low does inflation have to get to qualify for a soft landing? We might think about it. On not having a recession, or at least not having more than a mild recession, a key factor is how high we think interest rates are. We hear a lot about higher interest rates for longer, higher for longer these days. The Financial Times had a front page headline today saying that interest rates were at a record high. Well, hardly, unless you think history started just about the time current college students were born. 4 or 5% is a lot higher than zero, but on a historical view, those aren't what we have today, do not constitute particularly high interest rates. In the 50 years from 1960 to 2010, for example, 3-month Treasury bill yields averaged over 5% half the time, and over 4% for 70% of the time. And 10-year Treasury yields were 4% or higher over 90% of the time. So we might say what we're faced with is not higher for longer, but normal for longer. How long will that be? Now we know extremely low interest rates. And the bubbly asset prices they cause induce the buildup of financial structures dependent on the continuation of low interest rates to succeed or even survive. Well, no longer have such low interest rates. How many of these structures will be broken by the higher or normal interest rates for longer? Desmond published an article yesterday about this risk called, "Is the Fed ignoring signs of another financial collapse?" Is it? I put the question to my colleagues. And I believe that if the Fed gets away with only the bank failures of last spring of this year, it will be very lucky. As Desmond said, the banking system as a whole is loaded with interest rate risk and extremely large mark-to-market losses. And add to that, as he said, the looming commercial real estate concerns, the very large problems in the very large economies of Germany and China. And we ask, will we indeed get out of this landing without a financial bust? Finally, I'll just note there is another big and important balance sheet with gigantic interest rate risk. It's the balance sheet of the Fed itself. And its losing interest rate position has now generated operating losses for the Fed itself in the last 12 months of over $100 billion, which are also losses to the Treasury, losses to the taxpayer, and in effect increases in the deficit. How much more in such central bank losses can we expect in a soft or otherwise landing? Today, we have a panel of superb experience and knowledge to address these questions and think about these uncertainties. Each of our speakers will make opening remarks of about 15 minutes in the order of Kevin, and Don, and Bill, and then Desmond. After that, we'll give each panelist a chance to respond to the others or to clarify points, and then we'll move to a general discussion, including questions which you all with us by Zoom can submit to AEI at the email address beatrice.lee@aei.org. That is beatrice.lee, L-E-E, @aei.org. And after we have clarified, I'm sure, a great many things, we will adjourn promptly at 4 o'clock. Kevin, it's great to see you again at an AEI event, and you have the floor.
Alex, thank you very much. I think it was about a year ago that you and Desmond summoned us together. So I appreciate coming back to answer 5 simple questions that Desmond outlined at the beginning. It's great to share this panel with Bill and my old colleague, Don Cohn. I'm going to try to do 4 things before answering those questions because my answers are short, quite negative, and I think need a bit of context. First is I'm going to thank this group for including me. Second, I'm going to take some panelist privilege with the subject matter, the highlighted question of has the Fed produced a soft landing? Third, I'll look back just a bit so we have context of the last 12 months and longer. Fourth, I'll just talk about the current policy conjuncture. And then fifth, I promise to answer the questions you tasked us with at the outset. So first, a hearty thank you. The robustness of this discussion a year ago, I think, was important. And I only hope that as policymakers are debating these questions, they have this kind of robust discussion. Certainly did when Dodd and I were colleagues, and it's probably needed now more than ever. Second, panelist privilege here. I take a bit of minor exception to the framing question, has the Fed produced a soft landing? Imperialist ambitions notwithstanding, the Fed can induce hard landings, but from my way of thinking, it cannot produce soft landings. Soft landings owe themselves to the micro foundations of macro, to the underlying tenets of this economy. And I hesitate to ask too much of our government, ask too much of our central bank, and demand too little accountability for them. I know many commentators in the last several weeks are prepared to give out blue ribbons for the recent conduct of monetary policy. And I'll be happy to sort of share a bit of praise for that. But this is a cycle, and I wouldn't exactly say that this is a gold medal event in the last several years. So that's my panelist privilege. Third, let me look back a little bit. Like Caesar, we come not to bury the Fed or praise it, but to be honest with it. So the goal here among the 4 or 5 of us is to improve upon the current conduct of policy. If we look back just a few years, It's now, I think, rather obvious that the Fed's monetary policy has been deeply unwise, imprudent, and driven a tremendous amount of harm. Now, I don't blame the Fed for a misjudgment. We make misjudgments as policymakers all the time. That's part of the business. But it wasn't simply a misjudgment that inflation was, as the saying went, transitory. It strikes me that the mistakes were more embedded, more deeply rooted, and even to this day, less resolved. There are a series of intellectual errors that, as far as I can tell, the Fed and other major central banks haven't really wrestled with. I'll just note a few of them, Alex. First, the August 2020 Jackson Hole new monetary policy framework that the Federal Reserve put out. I don't think it's been renounced. They haven't talked about it in a couple of years, but they announced it as a brand new way to make policy. This was this fair average inflation targeting regime. And if we take it seriously, and having run so far above the inflation target for so many years, I presume, absent the policy being reversed, they'll need to run way below that, to the tune of inflation of 0 or 1%. So that's a framework that I think certainly needs updating, and I don't think it's proper to wait to the end of the cycle to improve upon that. Secondly, there continues to be a preoccupation at the Fed with monthly inflation tallies to the 100th of a decimal point. I think this misunderstands the true nature of inflation. There seems to be some confusion about relative changes in prices across asset categories, across groups, without understanding that what we're really worried about is an overall change in the price level. To not confuse the subject, what we care about is the climate, not the weather. And looking to the 10th of the decimal point and saying, oh, inflation's doing better this month, we can change policy, strikes me as falling for a degree of precision that doesn't exist in the data, and that in some sense created this monetary mess. In addition, what we've seen is a creation of new inflation measures. What did we call this one measure the Fed created with non-housing services as the be-all, end-all? Yet there's been barely a reference to it over the course of the last 6 months or so. I hope that's not because the new measures are inconvenient. Finally, I think there's been confusion about what causes inflation. Is it too many workers getting paid too much money? Is it the Phillips curve trade-off? Or really, was it just that this surge in prices really was transitory? It just took too long after all. I listened to yesterday's discussion by the Fed, and I couldn't quite divine what the theory of inflation was, other than it's better. Again, I think it's important that the Fed describe what is the causes of inflation, what they're doing about it, what their policy does to affect it. And I think these are serious intellectual errors that if we are to really resolve and learn from the circumstance, we should wrestle with. Only two more intellectual errors I'll call out here so as to not dwell. There was talk for years about R star, this neutral equilibrium real interest rate. Now it's sort of dismissed as being trivial in importance. I won't debate here its application, but I don't think R star has much to do with the current conduct of policy, nor should it, because we really can't observe it. Only in history do we understand it. And finally, there were two references, Desmond, by you and by you, Alex, about whether the rest of the world matters here. I can't help but think that most of the big central banks seem to be operating as though they're in a closed economy, as if inflation everywhere else in the world is somehow a coincidence, as if the recent pause by the Bank of England, the ECB, the Fed, this is also just fortuitous. It strikes me that these are not random events, that there are certain spillovers and spillbacks we should take seriously. And I can't help but notice what I said a year ago. We would have been better off in the United States in dealing with inflation had we been able to do it, taking account of what other central bankers were doing, and to announce all together in somewhat more synchronized fashion that we're serious about this global problem. So that's the negative. To give them credit, in the last 6 months or so, even the balance of 2023, I've got considerably more constructive views about the Fed's decisions, but again, their rationale seems to be ever shifting. Here's a simple rationale that might be practiced. They raised the policy rate ahead of the inflation rate, and the inflation is falling. Here's another. They've been more resolute on their communications, serious that they're going to bring inflation back to target. And finally, quantitative tightening has been working effectively in the background to try to drain money out of the system. It's simple, but I haven't heard much of any of those. And as for the next steps, which I'll turn to now, Alex, imagine that inflation were immaculately and immediately back at their 2% target. It still does not remedy the harm that has been done of a deeply regressive tax on the least well-off among us, a cumulative erosion of take-home pay to the tune of about 20%, a new uncertainty for households and businesses about their decision-making, which is a deadweight loss to the economy, and an inflation risk premium, which I think is lurking out there somewhere. I think none of us on the call, nor do financial market participants or business leaders, know whether we're entering a new era of price instability. These are expensive. And even if policy is perfect from here, I think it's quite a bit to dig out from those holes. Fourth point to raise, final one before answering your questions. What about policy from here? I think the policy conjuncture is highly problematic. My own judgment, Alex, is that monetary policy is working at cross purposes with most of the US's other governmental policies as we sit here. Monetary policy, as the chair said yesterday, is restrictive, at least to some degree. But my reading of fiscal policy is it's still quite expansionary, not simply in G, government spending, but in I, a series of credits on the business side to goose the economy that will certainly last over the course of the next 12 months. The deficits that we're living with at a time of full employment are illustrative of the massive accommodation by our overall government. Moreover, I'll say the government looks like it's choosing to absorb more of the private sector. So the question is whether this regime change in the role of the government and the private sector is positive and offsets, and is offset by, I should say, large government multipliers that are coming from the last $5 trillion of government spending. Very hard to know, but I'm somewhat skeptical. The last several trillion really was worth all the bang for the buck. And if you want to try to measure what do markets think about the future, we spend a lot of time in policymaking circles thinking about the policy rate. But 10-year treasury yields, I think, used to be the first thing that Don's former boss and my old friend, Alan Greenspan, used to look at when he wakes up in the morning. 10-year treasuries are a far more important indicator, it strikes me, of actual financial and economic conditions than the policy rate. And it's worth due consideration by the central bank. And for the first time in years and years, 10-year treasury yields look like they're being set between willing buyers and willing sellers. I'm not sure that the world central banks like what they're seeing in that. Maybe the 10-year treasury is telling us something. Since spring, it's up about 110 basis points. Since earlier this month, it's up about 35 basis points, back to levels where it hasn't been in 16 years. The seller of these treasuries has new and growing needs, and the buyers of these treasuries have new and growing demands. The Fed might be a bystander, but with $33 trillion of outstanding debt, every additional point, as I mentioned at the outset, above that interest expense established as a forecast by the CBO will only cost us about another $2.2 trillion. And so financial conditions and economic conditions are tightening, even as the Fed and other central banks seem to be pausing. And with all that said, I would say we are ill prepared for the next downturn, no matter what one thinks of the probabilities. So I'll turn finally, Alex, if I've got just a moment, to the questions you asked. My answers will be swift. Will the Fed get this soft landing, whether produced by them or someone else? My own judgment is it's unlikely. The consensus in markets is now quite enthused. The Fed seems quite enthused that they're going to have a soft landing, have almost no sacrifice to pay for it, and they will have navigated this quite well. My own judgment is, in spite of the government wishing it, that soft landing is unlikely. And it's less likely today than it was 6 weeks ago. The dollar is up, energy prices are up, interest rates are up, and wages are up. The economics that I once learned said none of that is good for a soft landing. All that says that the economy will weaken, profits will weaken, and the central bank might be called on to be more accommodative, not less. Second question, has Fed policy been appropriate? You heard my answers. I think the answer is no, but it is much improved over the course of 2023, and for that, we should be grateful. Third question, is another policy rate increase necessary or needed? The Fed sounds hawkier than I would be. I don't think it should be necessary to raise rates again. Having said all that, I don't think it would have been necessary to raise rates to this level had this inflation problem been quashed earlier with more resolute spirit, with clearer language. Had the language of 2023 been used even 6 or 9 months earlier, I don't think we'd have to be at this high level of interest rates. But the more you fall behind, the more you let inflation run in front of you, the bigger the problem is. Fourth question that was asked, has there been sufficient attention paid to strains in the financial system? I'll keep my record going with another no. I don't think there has. Central bankers here are riding a tiger. I believe that the underlying markets and economy are more vulnerable than the consensus would have us believe. Markets tend to like to wait until everyone's in the pool before they have a big disturbance. And if I were sitting in the old chairs that Don and I sat in, I would not be overly sanguine or overly comforted by recent developments. You asked just 2 or 3 more quick questions. Is the Fed sufficiently attuned to external developments? Again, the answer in my view is no. I remember a time when trade was an important measure of what was going to ultimately happen in our economies. Trade flows in units are trending down massively, decelerating massively in almost every major G20 country in the world. And those are indicative of history as a guide of a global slowdown. We see it in China. Yep.
1 minute to go.
Perfect. We see it in China, we see it in Germany. And if trade is the indicator it once was, we'll see it in most of the G20 countries. Again, I'll quote Alan Greenspan. The US, he once said, could not be an island of prosperity. I tend to think he was right. He also once said that GDP is getting lighter. Well, I sure hope this move to the services side of the economy is permanent, because GDP looks quite light as it's on rails crossing borders right now. And then the final questions you raised about raising the inflation target. It's a clever idea, and I think a very dangerous one. As Don knows, I never liked 2% as a fixed inflation target, but we're stuck with it. And I think once you're stuck with it now, you're stuck with it. I fear that the central bank will be comfortable with any inflation rate that starts with a 2, but I think it would be dangerous, and I would advise them not to be clever. And lastly, you asked, how do we get out of this cycle? I'll give the same answer I've given now for about 10 years, reform. Reform of these institutions, reform of their practices, rigor in what we've gotten right and wrong. And hopefully from this period where everything seems to be going well, this is high time to look at various instruments of reform. Alex, thank you very much.
Thank you, Kevin. Don?
Thank you, Alex. Great to be back with everybody again and have this discussion again. Good to see all of you. So I think I'm just going to proceed with trying to answer the questions, and I'm going to group them. The first question, as Kevin just reviewed with us, was the soft landing, and second one was the appropriateness of Fed policy. So I think recent data are encouraging, as Kevin pointed out, that we're moving towards a soft landing. Whether we get there or not we have yet to see. We've had declines in inflation, core inflation in particular. Oil prices are pushing headline inflation the other way. And that those declines, which were larger, I think, than any of us would have predicted a year ago, have occurred despite the fact that growth has been solid and the unemployment rate has remained quite low. So I think there are some, and Chair Powell did mention this yesterday, Kevin, about unwinding of some of the COVID-related issues, as well as the tighter monetary policy contributing to this effect. The Fed, in its forecasts that it released yesterday, has a perfect soft landing. They have inflation coming down to 2% over the next couple years, unemployment remaining right at the 4% level, which a lot of people think is a good approximation of full employment, and growth staying very close to the growth of potential. That's why the unemployment rate remains low. I would say I'm a little skeptical that things are going to turn out this well, just from a medium-term macroeconomic perspective. I think there's still quite a bit of tension in the labor markets. It's true that there's been backing off in terms of vacancies are down, quit rates are lower, wage increases are coming down, though they're still way too high to be consistent with a 2% inflation rate. Layoffs are very, very low. So I think there's been some softening in the labor market and in signs other than the unemployment rate, but I think it's still very tight. And I would be skeptical that just restoring balance in the labor market is going to be enough to keep the inflation rate on the track that the Fed has, or that I think is kind of necessary. Coming out of a period of high inflation with now upward pressure from energy prices, I think it's important to get those inflation rates down to prevent expectations from rising. So I think in order to do that, they're going to have to damp demand a bit more than it's been damped so far and create a little bit of slack in the labor market. So I think a softish kind of landing is entirely possible, but not one in which we just coast along at full employment. I mean, it's certainly possible, but I think I would put the odds on that, which would be a great outcome, as kind of low. Fed policy. So what do they need to do to create this kind of at least a little bit of relieve more pressure on the labor market? I think the Fed, and here I echo Kevin, made a bunch of mistakes, reacted late to the rise in inflation, put too much weight on the transitory factors coming off. This is, I think we all four of us criticized the Fed for this a year ago, and then there was another panel 6 months before that where we also criticized the Fed for that. But I think the Fed deserves considerable credit for recognizing its error and moving very rapidly to correct it. So they moved up in 75 basis point increments for a good half or 3/4 of a year. I think having gotten rates up, they slowed the pace of increase, and progressively from 75 to 50 to 25 now to every other meeting. I think that's a well-designed policy path. Once you have policy in the restrictive territory, to try and figure out how restrictive you need to be to accomplish your objective. So I think I agree they made bad mistakes a couple years ago. I think they should be applauded for recognizing that and correcting for it. I think despite the higher interest rates, of course, spending has proved very resilient so far. That could be, it could be that there are lagged effects of policy coming into view, and I think the credit tightening in banks probably takes longer to work through to the economy than things like higher interest rates or lower equity prices. Equity prices have turned around. You've got all these the households and businesses locked in low interest rates on debt in the zero interest rate period, and they'll have to refinance that. So I think there could be some tightening effects coming. But my guess is that in order to accomplish their objective, they probably need to do a little more. I'm uncertain about how much more, and I think that uncertainty is an important point. It's very, I mean, this is, Alex, this is your point about landing the 747 with the windshield blacked out and all the information you're getting is what's happened behind you. I agree. I mean, it's very, as Kevin and I remember, it's very difficult to fly this plane and figure out what's going to happen next rather than what just happened before you did it. And I do think the bad experience with projections and forecasts makes the thing even harder, because you have lost confidence in the framework, the intellectual framework you were using to predict inflation going forward. And therefore you start looking, and this is a point Ben Broadbent of the Bank of England made at Jackson Hole, and I thought it was a very perceptive point. You put more weight on things like wage and price increases, the stuff at the end of the chain when you don't have confidence in your knowledge of the chain. And I think that it's understandable, but it just makes the policy much more difficult if you're uncertain about the effects of your policy on the economy. So overall, I think there are decent chances of a softish landing. Policy has corrected its mistakes. I think it probably needs to do a little more, but I'm very uncertain about that. So those are the first two questions. The second two questions is how much attention should they be paying to financial stability and foreign developments in the making of policy. So I do think built into the policy process, as Kevin knows, are forecasts of what's going to happen in financial markets, certainly reacting to what's already happened, what's happened to financial conditions already. So you're reacting to that. And you're reacting to projections of what's going to happen in foreign economies. So those are part of the forecast process. They are built in. I think in terms of China, it's a very serious problem for China. The direct effects on the United States probably aren't large, but there are a lot of indirect effects for what effect China has on other of our trading partners, Japan and others. So, but I'm sure that the FOMC is thoroughly briefed and been thinking about those effects. So I don't have any evidence that they're not focused on that. And I would say in terms of some of the structural issues, Kevin was pointing to the decline in trade, the reconfiguring of supply chains. That was a big part of the conversation Jackson Hole this year. So that's certainly on their radar screens. I think maybe the question you're raising, Desmond, is whether policy should adjust, monetary policy should adjust to threats from financial stability. And this is a conversation Bill White and I have had for several decades now, I think, Bill. But I'm very reluctant to steer away from the price stability, economic stability goals of monetary policy to take account of a potential for a financial accident in the future. So I think the best thing the central banks can do for financial markets, for our economies, is to achieve price stability and achieve economic stability. I think they need to pay attention to it, but not with monetary policy. So I think we saw this spring in March that there are serious reforms needed to the way the Fed supervises banks. And I hope they're moving on those. They need to work with other agencies about the risks in the non-bank sector where they have no authority. So I think there are threats to financial stability. They need to be leaning on the banking system to protect itself, to manage its risk much better than they were leaning on them and working with others to deal with the non-bank financial system. But I wouldn't change the course of monetary policy because I was worried about some potential financial stability threat out there. The last two questions, I would put under longer term sort of framework review. So should they be thinking about talking about raising their inflation target, and what can they do about these asset price fluctuations that have accompanied monetary policy for a long time? So I think one thing, let me cover the second one first. And coming from what I just said, it won't be surprising to hear you say, hear me say, asset prices vary. They go up and they go down. People make money, they lose money. They need to protect themselves against this. That's not the job of the Federal Reserve, to stabilize asset prices. It is the job of the Federal Reserve to stabilize the economy and monetary policy, and to stabilize the banking system and their supervision and regulatory policy. But it's not their job to stabilize asset prices. When I was serving on the Financial Policy Committee at the Bank of England, Mark Carney used to say, it's our job and the FPC to stabilize the financial system, not to stabilize the financial markets, prices in the financial markets. And we said that publicly a lot. And I think that I would say the same thing about monetary policy. But I do think, and so I think monetary policy ought to be aimed at its dual mandate. But I do think in this framework review that Kevin mentioned, should think about the contribution, about how forward the unconventional policies might have contributed to some of the asset price instability. So the forward guidance for interest rates, in which they vowed to keep interest rates at zero until the economy was at full employment, I think was way too specific and way too easy, was one of the things that contributed to the mistake that allowed inflation to get going. I think the QE, the amount of securities they were buying, how long they contributed, the fact they were buying mortgage-backed securities while the real estate market was on fire. I think the unconventional policies in particular help to contribute not only to economic and price instability, but also to financial instability by reinforcing some of these zero rate stuff and taking away some of the uncertainty about what's going to happen that naturally should be there. So they have said they're going to review their framework every 5 years. I hope that part of that framework review is, first of all, consistent with what Kevin said, looking back and saying what went wrong, where did we steer wrong, and what should we correct to do that with our framework. But secondly, and not totally part of the framework, but certainly adjacent to it, is these unconventional policies. How can we do a better job of keeping the unconventional policies well targeted for economic and price stability, and perhaps minimize their effect on financial stability? And the fact that you've got several instruments here, you've got the actual short-term rate, you've got expected short-term rates, and you've got portfolio purchases, suggests that there might be some subtle, flexible, nimble ways of using the three instruments to achieve your objectives for the economy and minimize perhaps their effects on financial stability, certainly highlighting the uncertainty. On the inflation target, I agree with
Not 1 minute here.
That's fine. Thank you, Alex. I agree with Kevin. I think the key is to bring up Alan Greenspan again. He defined price stability as where households and businesses don't have to pay any attention to it. And the question is whether 3% is low enough for that to happen. And people don't like inflation. They don't like it because it interferes with their planning. It interferes with the signals they get from the markets. So I'm not sure 3 is low enough. And I think right now would be a bad time to do that. So you can only raise the 3 if you've already gotten down to 2. and prove that you can be at 2. Otherwise, people will assume every time you get in trouble getting inflation down, you're going to raise the target. So I think it's worth thinking about. Now is not the right time. I would hope that part of the framework review, they think about a little flexibility in their inflation targeting. So maybe a 1.5 to 2.5 range or something, so they don't obsess over a couple tenths either side of 2. So I think there are things to think about there, but I wouldn't raise the target now. Thank you, Alex.
Thank you, Don, very much. Go on to Bill.
Is I have some slides, so let me try to put them up. Go. That is that all right now?
I see it's blue for me.
Sorry? Can you see them?
It's a
There we
little
go.
slide.
All right.
There you go.
Okay. So the question, has the Fed produced a soft economic landing? My first point, I guess, is that a soft landing is possible, but I think it will be only temporary. Frankly, I think all of the discussion that we hear about this sort of near-term prospect for inflation, you know, the decimal point stuff that Kevin was responding to, it's got very much the air of how many angels can dance on a head of a pin. I think I agree with Kevin that really the Fed and all of the central bankers have for a long period of time made a number of really fundamental intellectual errors. I'm going to, I think in the limit, what I would contend is that the Fed and all the others should recognize that the economy is not linear and deterministic, as their models would seem to imply, that it's a complex adaptive system that is much more complicated, and it demands a very different form of governance. But I won't go into that right now. Let me just talk about some very specific things that have to do with that intellectual failure. And I think I'm going to raise some issues that in fact have not been raised thus far. I would say that the Fed has put too much influence on aggregate demand issues, the Phillips curve, that kind of thing, really for decades. And it's put too little emphasis on both aggregate supply and financial developments. In particular, over the course of the last number of years, where globalization, et cetera, has led to inflation really tending on the downside. And the reaction, of course, has been very, very easy money because inflation was not a problem. And the upshot, I think, is that it's created a lot of instability, particularly on the financial side. And I had a quote here from Paul Volcker's autobiography, which I think is lovely and absolutely on point, where Paul Volcker said, ironically, the easy money striving for a little inflation as a means of forestalling deflation could, in the end, be what brings it about. So that in a fundamental sense, we have some intellectual failings here. In the same sort of way, I think, as the Fed sort of ignored the positive supply side shocks in the past, we have a problem coming down the road. I'm going to focus my attention on this, on aggregate supply problems, which I think are going to get much worse. And I'd like to say a few words about those problems. Basically, because if we've got negative supply side shocks, many of them coming down the road, the Fed and other central banks are going to have a persistent problem in having to choose between slow growth, you know, pumping up growth, which makes for easy money, or resisting inflation, which means for tighter money. And I think those difficulties, which imply both financial instability and fiscal unsustainability, I think the worry is that the difficulties posed by those problems will, in the end, lead the central banks, the Fed and central banks more generally, to compromise with the inflation objective. I fear that that's where all of this is going to end. Okay, Let me just say briefly why I think we've come through a past age of plenty. There have been a large number of shocks, if you think about them, going back over the last 20 years or so, which have really led to both faster growth and disinflationary pressures. And I'll just sort of run through them. One of them has been political order and the benefits of globalization. Okay, so when the wall came down and China and everybody came into the global economy, that had a tremendous impact on both growth prospects and lowering of inflationary pressure. Favorable demographics. My old friend and first boss, Charles Goodhart, with his colleague, has written a whole book about this. The demographics in the advanced market economies, the baby boomers coming through, pushing up supply, China and the others coming back into the global financial system, again, pushing up supply, rising participation rates, better educated workers. All of these have been positive developments. The focus on efficiency, associated really with people going to global supply chains and really focusing in on making the most of the resources that they had available. Plentiful energy and other resources. We have big increases in food demands, big increases in demand for energy. Those demands were met with a very elastic increase in supply. Nobody was worried about increases in coal and whatever, it just happened. Supply went up to meet the demand. Growing digitalization, the whole business about the web and all of the good things that have followed from it. So those are all positive supply things. In addition, I think it's well known that we had investment levels that were lower than had been traditional. And why was investment low? Well, there's a lot of explanations, but one of them, of course, has to do with if there's lots of labor and falling real labor charges, why invest when you can use labor as opposed to capital as a factor input? So demand was relatively less great. And as well, we had less need for guns and butter, because this thing that the fall in the wall, et cetera, was all associated with the end of the Cold War, demilitarization. And the butter thing, of course, was we had the Thatcher, Reagan, whatever, that basically said the markets will sort it out. We don't need to do distribution, active redistribution policies. So the end result of all of this was lots of supply and not so much demand. And the overall environment really was one of disinflation. And of course, the central bankers trying to back the demand back into it, did so with easy money. So that was the age of plenty, but it's past. I think what we're heading into now is a future age of scarcity. For a starter, we've got a lot of heritage problems. Underinvestment, which I've already referred to, malinvestment, the easy money that we've had over the course of the last 20 years, the zombie companies, the companies supported by their banks, the companies that will never make a profit, all of that capital is sunk and gone. So we have a problem with what I call heritage problems. The political stuff, before it was political order and globalization. Well, now, particularly with the China-US thing, it's going to be political order and deglobalization. Nobody's got the slightest idea of how far this will go, whether it'll be a narrow terrain and a high fence, or whether it'll be a big terrain and a high fence. We don't know, but it's going to be very costly. Unfavorable demographics and falling participation rates. So the baby boomers are gone. I think mention was made of that earlier on. Same thing is going on in China, Korea, Japan, the workforce everywhere in the sort of the countries that are tightly wedded into the global production sector is all falling. The focus on resilience, whereas previously, I'm just mapping the previous slide, whereas before the focus was on efficiency, and now it's going to be in resilience, which is a very different thing and will be more costly to produce. Scarce energy and other commodities. I said earlier on that food, energy, fossil fuels, no problem. Well, of course, the very opposite applies at the moment. We've got a climate problem that I think is going to be much more severe than the markets currently seem to anticipate. So this is going to be extremely costly. The benefits of digitalization and connectivity. Here, I think there's an open question. A lot of people talking about AI, very positive implications for productivity. Could well be, but the jury, I think, is still out. Bob Gordon and other people are not prepared to say that we're entering a new era of higher productivity, and neither am I. Whereas previously, and now I move on to the demand side, whereas previously I said that investment was low and that was sort of taking the edge off demand. As you look forward, it seems to me the very opposite is going to apply. So if you look at this slide and you sort of start at the top and you work your way down the negative supply shocks down towards the bottom, every one of those negative supply shocks implies a need for a positive investment or aggregate demand shock. So the heritage problems speak for themselves. You know, too little good investment in the past, more of it is going to be required in the future. Deglobalization, setting up new supply chains, it's all going to take more investment. The demographics, we're going to have to replace workers that aren't there with more investment. Scarce energy and other commodities. When you start talking about the investments needed for adaptation, okay, the climate's going to get warmer. What are you going to do? Building walls around the Netherlands, building walls around Manhattan, all of this stuff is going to be enormously expensive. So there's going to be rising investment. This is my second to last bullet point on this. There's going to be rising investment needs in the face of supply shortages. And then in addition, the guns and butter thing is turning around too. So we had the benefits from the end of the Cold War, but now military expenditures are rising rapidly everywhere. And I think we can see that the writing is on the wall for still more of this stuff. And as for the butter and the worries about inequality and political discourse and all the rest of it, I think that's a problem coming down the road too. So as I look forward, it seems to me that the era of low inflation and easy money is about to give way to one of higher inflation and tighter money. And this is where we get into the worries that everybody else has mentioned. And I think they're made worse by these supply side problems that I'm talking about. One of the problems is that tighter monetary policy could trigger financial instability. And I think that the instability in part has been fueled by decades of ultra easy monetary policy. People were given the incentive to do some truly stupid things, and we still have to see the fallout from that. When the profits that they said they would make, it turns out they're never going to make. We've got record high debt levels of decreasing quality. I'll just focus on the United States. There's been a lot of progress made in terms of household debt and corporate debt, but there's still a lot of concerns, and people have raised them earlier about commercial real estate in particular. Asset prices, it was mentioned, only 5% stock market below previous record highs. A lot of grounds for belief that that may be higher than is really supported by the underlying realities. We've talked about the banks, problems of instability at banks. There's been a massive movement out of banks into non-bank financial intermediaries, in large part because of better banking regulation. But what it really means is that we have no idea of what is going to happen in the context of tighter monetary policy and half of the financial system. And then we've got the markets functioning badly. You know, the last 20 years or so, you look at all these flash crashes, these market anomalies where arbitrage conditions don't work properly anymore. The US Treasury market, we talked about what happened in the fall of 2019, in the spring of 2020. The basis trade is back. I see more and more articles in the press about what's going on there. And I think that these private sector problems could in fact lead to a financial bust that could lead to recession. I'm not saying it's inevitable, But the more you've got these negative supply side shocks to worry about, and the higher interest rates have to be, the more you'd have to worry about financial instability. So private sector debt is a problem. But we also have an increasing problem on the public sector side, where tighter monetary policy could trigger fiscal unsustainability. Now, fiscal unsustainability, I think, has not been fueled so much by discretionary monetary easing, discretionary fiscal easing, as we've seen the discretionary monetary easing leading to problems further down the line. It's mostly just by decades of asymmetric policy, that fiscal policy never gets tightened as much in the upswings as it eases in the downswing. And the upshot is the debt levels just get higher and higher. And of course, you're all familiar with the fact that the deficits have really been swollen by the COVID and the energy price shocks. The fact that we've got, I think in the US now, what, 7-8% deficit at full employment. The estimates about what happens to the debt ratio already over 100%, heading sharply higher. I really worry this is an accident waiting to happen. The higher rates, of course, are raising debt service.
I hate to interrupt, Bill. I hate to interrupt this really brilliant talk, but you are getting to the end of your time here.
Okay, I'll just finish by saying this, that we have got big fiscal problems, and that the answer really to all of this monetary stuff would be to have more cooperation, in a sense, on the fiscal side, to get more of an alignment on the fiscal side to try to reduce the deficit. The problem, of course, is that much of the that the scope for reducing expenditures in the context of climate change and all that other stuff that means more government spending for investment implies that the only way to square the circle is less consumption, and there's absolutely no political appetite for that. And so going forward, we have a longer term problem of significant magnitude, and it worries me.
Thank you very much, Bill. Desmond, you bring us to our last speaker.
Just let me see if I can share my slides. Yeah, okay, I've got the slides up. Coming last, there's just a whole lot that I can agree with on the previous speakers, but I guess I'd put it together in a somewhat different way, that would show that I really just don't see how we are going to get a soft landing. And I'd be very surprised if we don't get a hard landing, because of what I think the errors being made by the Federal Reserve. And I think that these errors are egregious errors, that fly in the face of a lot of experience. So let me just mention 4 fundamental errors that I see. The first is that we've got a Fed that is totally data dependent. They look at each inflation number. It reminds me of working on Wall Street, like hedge funds, changing their position every 2 minutes, depending on how the flow of data comes, and forgetting that monetary policy operates with long and variable lags. And I think that this is particularly important right now, when you've seen such large increases in interest rates in a short space of time. You don't expect to see those results till 12 or 18 months later. And all of this occurred in around about June to the end of last year. So we've still got to see what the tightening of monetary policy is. So I think that that's one of the major mistakes that they make. The second mistake is that they really don't focus much on the financial market risks. And as I'll elaborate shortly, that these, I think, are in plain sight, that we've already had the warnings of a couple of regional banks of significance blowing up. We know that there are real problems in the real commercial property space. We're seeing defaults in high leverage loans, et cetera. We've seen the normal credit cycle. So this is going to be a credit cycle that I think is once again going to be on steroids, but the Fed just seems to disregard it and keeps raising interest rates. The third basic point that I think that they disregard or they downplay are the attention to external events. And I think that this is totally inexcusable when you've got the second largest economy in the world in deep trouble, that you can see. And now what we're seeing is Germany's in recession too, so it's just a matter of time before we have Europe having real problems as well, with their exchange rate. And the last point that I want to make is that the Fed basically ignores money supply movements. And I wouldn't describe myself as a monetarist, but when you do see the money supply increasing by 40% in the space of 2 years, that's something unusual. And now what we're seeing is the money supply contracting at a way that we haven't seen before. So it's telling you something, that I don't think that you can just totally disregard it. You don't get the Fed talking about the money supply. So those are basically the 4 reasons why I think that we get the hard landing. So let me just elaborate on each of those. The first is they really don't take into account the monetary lags. And this chart really just shows, quite dramatically how you've had the increase of interest rates of 525 basis points in something like 16, 17 months. You look at the previous tightening cycles, we've seen nothing like it. And what you've got is, in addition to the interest rates being jacked up, what they're doing is they're withdrawing market liquidity at a rapid rate. So we haven't been here before. So you've got 2 things going on, that are pretty big. And I would think that you really need to wait. You need to be patient to see what the results are before, you just keep jacking up the interest rates if the inflation doesn't come down right away. The other thing is that it looks like you're getting tightening in the commercial, in the bank lending, so you've got all of this tightening going on. Give it time, don't expect to see it, don't let your policy get blown around by the fact that inflation ticked up because oil prices might be increasing. You now need to be really tough. That doesn't seem to me the right way to run monetary policy. You really need to take into account that there are long and variable lags. So that's the first point that I wanted to make. The second is the financial market risks. And I think that it's really what Bill indicated, that we've had many years of low interest rates. Those low interest rates induce people to do ridiculous things, to make really very bad investments. And now what we're doing is we're increasing interest rates at the fastest rate. So if you don't get financial market accidents, I'd be very surprised, but I'd say that we've already seen those financial market accidents. Now, what you'd get is the normal credit cycle stuff, like the highly leveraged loans. We're already seeing those go up, the auto sector, the credit card problems, all of that. But I think that that is really small beer in relation to the really big elephants in the room. One of them is the losses that the banks are taking on their bond portfolios. So what we're seeing is really massive losses in the banking system. There was a study recently came out. You're talking about the banks' mark-to-market books are $2.2 trillion below what their book value is. So you've already got that strain. If that strain's not enough, you've then got the problem in the real commercial property space. Now that is unusual. What's going on is you've got very high vacancy rates because of post-COVID, but that's not stopping $500 billion a year in rollovers coming due. I don't know how they can manage that, with vacancy rates, occupancy rates being so low, and now having to deal with high interest rates. So these aren't going to roll over. And this is really very important, because the regional banks have a mere 20% of their balance sheet is to these kind of loans. So they really having to contend with getting crushed with the high interest rates on their long lending. And now they've got a commercial real estate problem. How you're not going to get a whole wave of bank failures, and that the Fed doesn't anticipate that this is occurring. It reminds me very much of, when Bear Stearns went up, interest rates kept rising. That just doesn't make much sense to me. This is just another indication of the problem in real commercial property. Some of the investment banks, saying that you could see office space decline prices of office buildings, going down by 30%. So that means that a lot of those loans are already going to be impaired, which is real problems for the regional banks. So I don't think that they're paying sufficient attention to that. This is just another chart showing the exposure of the small banks. You can see the light blue line. Small banks are the dark blue line. You're seeing something like $2 trillion of exposure. You're talking about big numbers. It's not just the banking system that I'm worried about. I'm worried, what Bill was saying, that you've got a problem in the shadow banks. The shadow banks are the far larger part of the financial system. This is unregulated, with what's happening with the long portfolios, what's happening in real commercial property. You're really going to find LTCM or two occurring in this area. So that doesn't bode particularly well. Many of these hedge funds and the like are pretty highly leveraged. So I think that we've really got a problem. And, for the Fed to keep raising interest rates just seems to be inviting a financial crisis next year. The third point that I made was external developments, that I think that you can turn a blind eye to them when not much is going on in the external economy, but that's clearly not the case. This chart is just indicating China has got the mother of all credit market bubbles. This is worse than that of Japan that led to its lost economic decade. You've got debt to the non-financial sector going up by something like 100% of GDP in a short space of time. That normally doesn't lead to a good result. You've got the problem China going into deflation. And this chart just indicates, a point that I'm rather bemused at is, people saying the direct effect on the United States isn't very great. But, as Don said, the indirect effect can be very good. If it's impacting the rest of the world economy, that's not good. What stands out to me in this chart, this is a chart from The Economist, just showing what the exposure of a whole bunch of emerging market countries are to China. And the lower part is the advanced countries. But you see that a country like Germany, something like 3.5% of Germany's GDP is exports of goods and services to China. And then they're getting another 6% of earnings through their affiliates. So this China issue can really affect the global economy, and that can affect the United States. So to disregard that seems to be misplaced. And the last thing that I would say is the Fed, I just don't know how you can ignore a chart like this. This chart is from the St. Louis Fed. It's what's happened to the real money supply. You look at a chart like this, something's going on, that the spike in 2021, 2020 and 21, leads you to high inflation. Now what we're seeing is the money supply contracting in real terms, at a rate that we haven't seen before, that doesn't bode well. So when I put it all together, I think that it's far too premature to be talking about a soft landing, and I think that what we should be doing really is thinking about how do we approach the hard landing that we're going to see next year. That's what I've got to say, Alex.
Thank you, Desmond. Your usual cheery outlook along with Bill's. And that brings us to sharing ideas among the panel. As I said, I'm going to go right down the panel, 2 or 3 minutes. Anything you'd like to say to respond to other people or add on to your own comments? Kevin.
Great, thank you, Alex. I learned a lot from my colleagues as usual. I'll reinforce, add on to three bits of wisdom that I heard. First, what's the central bank's job here? I think what most of us had to say is the central bank's job is to worry when markets aren't worried. Markets seem to think all is swell, being dismissive of all these risks. Well, that's great, but measures of risk, real risk is highest when measures of risk are lowest. Central bank's job is to deal with tail risks. So while this might sound like a dour conversation to people that are listening at home, in some sense, that's good central banker training. And so I think the Fed should sound more worried than they did yesterday. I think their modal view of a no landing is out of character with the responsibility. And I'll just reinforce that with something Don said. When we talk about issues of financial stability, I share the sentiment Don had. It is not the central bank's job to keep financial markets happy or stable. It is not the central bank's job to keep the economy stable, in my view, or the financial system. Our job is to avoid tail risks, to avoid events of major instability. There still will be a business cycle and a financial cycle. There'll still be ups and downs in markets. And the Fed seems to have decided that it's going to cut off the amplitudes of all of those in all times. The Fed's job is to step up in 08 and 09, to step up in the COVID crisis. But it seems as though, to the title of this panel, Fed seems more interested in every month and every quarter. And I think that's a misunderstanding of the role and responsibility. That's point one. Point two, the question that you had asked that we've each opined on, which is what's the right inflation goal? I just want to be clear that I don't think it's right for all of us to be clever about this. I think Don rightly said that it is not the consistent with price stability for inflation target to be at 3%. Now, I don't think it's ever the Fed's job to assign a higher inflation target of 3%. That is too high. I think what too many households and businesses and market participants want to believe is, yeah, they're not going to change it now. But once they get back to 2 or 2 and change, then there's an incredible support in the academy among the great intellectuals, the great and the good, to say, well, not 2 now, but 3. Well, markets are forward leaning. I think they need to quash that once and for all and not be clever about it. And I've heard way too much cleverness on the subject. So that's the second point. Third point, I think each of us have talked in using various language about the degree of fiscal irresponsibility, the dangerous, unsustainable fiscal path that the most important economy anywhere in the world is on. And this is in a time of relative peace and prosperity. I think it is difficult for there to be prudent and responsible monetary policy when there's imprudent, irresponsible fiscal policy. And that is, in some sense, the great challenge. And I know the Fed does not want to be opining on issues outside their direct remit. But as 10-year interest rates move higher, if this is a regime change in that, it'll be hard to avoid the need for a new Treasury Fed accord. So 3 points, Alex, and back to you.
Thank you very much, Kevin. Don, further comments and reactions?
Just a few, Alex. First of all, I'd like to react a little bit to what Kevin just said, particularly the emphasis on tail risk. I think that's exactly what we thought we were doing in the Financial Policy Committee at the Bank of England, was taking account of tail risk and trying to identify fat tails and then strengthening the financial system so it would be resilient to an event that happened in that fat tail. I don't view monetary policy that way. So I think the job of monetary policy is price stability. And yes, and Alan Greenspan, again, to bring him up again, talked about buying insurance, risk management, et cetera. I think to some extent, the Fed's use of that term, risk management, has gotten very, very loose. But I do, so he could see that you should be aiming at price stability. That should be where you're going, right? And then occasionally the risk of falling short or on one side or the other of your goal, you should shade policy a little bit that way. But I don't think monetary policy can aim at the tails. It can shade a little bit if it thinks the tail's fat, but it can't aim at the tails or it won't produce price stability. There'll be an economic stability. So I think that's a trickier issue for monetary policy than I think Kevin may think. Actually, I just, on the presentations, which were all great, I have a question for Bill White. So I kind of agree with the thrust of his presentation, that a lot of the good stuff we saw over the 90s and the first half of the 2000s was a positive supply shock from various things that Bill pointed out. And that things are turning now. And what happened then isn't being repeated, and he pointed to half a dozen reasons why that might be true. So I guess my question is, what should monetary policy be doing? What should it be shooting at? And I think what I heard you say, Bill, and I agree with it, is should be shooting at price stability, not at growth. It should be shooting at, and in the United States, it has a dual mandate: maximum employment and price stability. Maximum employment being understood being whatever is consistent with price stability. And I think that's fine. That's what it should be doing. And if slower growth occurs because of supply constraints, there's nothing the central bank can do about that. So I guess it's a question for Bill. How should the central bank cope with the factors that you were pointing out?
I want to move to Bill in just a second, but before we do, I do have one question for you, Don, about what you just said. You said monetary policy should not shoot for the tail risk, but wouldn't you agree that monetary policy, if it really is mistaken, can create the outcome that was formerly viewed as a tail risk?
Yes, sure. Monetary policy makes mistakes and it creates, this is Desmond's point, has been his point for a decade or two, that monetary policy can create financial stability risks, and I agree. But I think it's hard to use monetary policy to deal with those risks. I've always been one that's been uncomfortable with the leaning against the wind argument that monetary policy ought to take account of those risks, because it implies steering away from price stability or taking longer to get to price stability. And so I think we need to develop, and this came up in several presentations, a more robust system for dealing with the financial instability. And coming from my Bank of England experience, I thought they had a much more robust system than the US does, with this balkanized regulatory system with no one really in charge of it. It's a problem in the US.
Thank you. Bill, let's come to you. You have a question from Don, and also time to react to anybody else or write further comments.
Yeah. I think Don and I have been having this debate for at least 20 years, if not longer. And I'm very much, and continue to be, in the camp that says leaning against the wind of credit, financial, monetary developments is really a very important aspect of macro stability. And I know that the counter argument, which Don has just used, is that it means then that you give less emphasis to near-term price stability. And I would say, yep, and that's probably a good thing. Because when you're leaning against the credit cycle. Essentially, what you're doing is you're trying to moderate the boom in the interest of moderating the subsequent bust. And if the bust, okay, will lead you to undershoot your price stability targets, even more than leaning against the boom will do so, then to me, it makes a lot of sense to do that. On the business about relying on regulation, I think we have a real problem in virtually all countries. And the problem is that the way we do things is fundamentally also unstable over time. So you see an example, for example, we think we can get bank runs. And we certainly know we can have bank runs, but you say you've got a problem with bank runs. Bank runs are costly, and therefore you need safety nets. And you say, safety nets, yep, we'll bring them in. And then you say, but safety nets create moral hazard. So, oh, moral hazard, then we need more regulation. So you get more regulation of the banking system, which just induces people with the help of technology to move into the secondary banking system. And then we get a run in the secondary banking system, which is exactly what we saw at the beginning of the great financial crisis. So we say, oh my God, so now we have got to extend the safety net now to the holding, to the holding companies, and wasn't there before. This last time we wound up extending the safety net in the SVB thing really to all of the deposits in all of the banks. You can sort of see where this is going. And then, of course, a lot of people would worry about the safety net stuff. One, it just creates much moral hazard, so it gets worse and worse and worse. But secondly, it will be a drain on the fiscal purse, because in the final analysis, these contingent liabilities all have to be paid for. And so we have a further problem to add to all of the problems we have at the moment. So this, to me, it seems to me to say we need more of a belt and braces approach. Going back to what Kevin was saying and others, we don't really understand. We've got to be more humble about what it is that we think we can control. And I would say using monetary policy and macroprudential policy together to try to take the edge off the boom would pay very welcome dividends over time. So that's basically how I would respond to Don's question. And I would just raise again the broader problem that I've had now for many, many years, which is that the policymakers think the economy is somehow understandable and controllable. It's linear, it's deterministic, it will do what we say policy wants it to do. This is not true. The policymakers have made a fundamental ontological error. They've misunderstood the character of the system that they're dealing with. It's a complex adaptive system, and it needs a wholly different governance framework. And going back to what Kevin was saying was, for a starter, we should always expect in these systems the unexpected. We should not try to take the last dollar of GDP out of the system because we don't know how to maximize. We should be trying to minimax to avoid really bad things happening. And the list sort of goes on and on. I think we need a total reorientation at the intellectual level of how monetary policy works.
Thank you, Bill. As a former student of philosophy, I have to agree it's not only an epistemological problem, it's also an ontological problem about the nature of the strange thing that we're trying to deal with here. But it makes it fascinating and gives us great conferences. Desmond, reactions to other people?
Yeah.
Or further comments on your own thoughts?
Yeah, I'm certainly not going to talk about Aristotle, but the 3 points I'd want to make is, first, I think that Kevin and Don are being far too kind to this Powell Fed. I think that what happened in 2021 was just totally inexcusable. At the time that you had fiscal policy, the American Rescue Plan pumping in $1.9 trillion into the economy, and the Fed does nothing. It just leaves interest rates at zero. just is inexcusable, allows the money supply to balloon by 40%. And then you get surprised that you get the inflation. I think that is, criminal. The second point, I was on the idea of what the central bank should do on to maintain financial stability. I totally agree with Bill that by creating financial instability, by allowing these bubbles to form, either in the asset price markets, the equity bubble, or else the credit market bubble, we pay very dearly when these bubbles burst. So I think for the Fed to keep interest rates at zero, to have engaged in quantitative easing the way in which they did, when asset prices were on fire, that is just a fundamental mistake that hopefully that they avoid. The last point I want to make is just with Bill, I agree that all of the points he's making on the supply side, that there've been changes, demographics, like the climate problems. But I think that, we really don't know about this technical progress. It seems that we're on the cusp of something huge that is occurring. It's not just the artificial intelligence. I just noticed one of the investment banks are saying that 300 million jobs are in jeopardy because of this artificial intelligence, chat GPT and so on. But you've also got 3D printing, you've got driverless cars, you've got robotics. All of that can be offsetting those supply side. So there are people like Yuval Harari who concerned about where's this technical progress. We're going to have everybody out of a job. We need basic incomes to keep this going. So there's some sort of tension there. I'm not so sure which of these two sides wins, but I think that one really can't downplay that we could be on the cusp of something huge in the technological world that is going to be very productivity enhancing.
Thank you, Desmond. Let me turn, go ahead, Bill.
I would just mention, I totally agree with you, Desmond, about the possibility that you might have these very positive IT developments, okay? It's not impossible. But one of the things that we should keep in mind, and this was sort of one of the themes of that book, The Second Machine Age, by Brinfelson and McAfee, I think a few years ago. They were talking there too about the wonderful things that are coming down the road. But at the same time, it will exacerbate the problem of social inequality because it's a winner-take-all kind of world. And then you have to start thinking something we haven't spoken about at all, which is the extent to which these problems of crises or potential crises coming down the road, interacting with the degree of income and wealth and opportunity inequality that we already have, will not lead to serious political problems. And that's something I think that we should really sort of make sure that we get out there, that these economic problems are not going to stay in the economic sphere. To the extent that they cause difficulties on the economic side, they will cause problems on the political side and knock-on effects in terms of climate mitigation as well. So the stakes are very high here.
I've always thought the classic term political economy was a better description than economics of what it is we work on. I want to turn to a question from the audience, but I have to see if anybody else has another comment to make before we do. All right, here's the question. This is not ontological. It's very straightforward, and everybody will have a chance to answer it if you like. It's from Charlie Kimball of the Korea Center for International Finance, and it is, where do you think the peak Fed funds rate and the peak 10-year Treasury note yield will be? What will they be? Who'd like to get out there with a forecast?
Alex, perhaps I don't know where the peak's going to be, because I think that markets have the ability of, it's the famous Keynesian statement, that markets can stay irrational for longer than you can stay solvent. So I wouldn't suggest shorting these markets. But it would seem to me that if you do get the financial sector problems that I think, we'll see the 10-year rate come back down to the 2% level. So that would be my forecast. The end of 24, we're not going to see the
hard landing and lower
rate. See the interest rates coming back down because the Fed is going to have to pump this thing up again.
Any other thoughts? Anybody think we're at the top right now? Rates will either stay the same or go lower.
Alex, I'll weigh in. We just spent an hour and a half talking about humility, so we need to keep that in mind as we opine. But your listener asked the question, so I think we owe it to him to give our best judgment. I expect that we've now reached the terminal rate for the Fed policy, and I suspect the Fed hopes and believes that too. I won't go on, but I think we're probably there. Secondly, where does the 10-year Treasury yield go? I would say it first goes materially higher than where it is now. And I'll describe that in two ways. One is it's always in markets a dangerous and expensive game to think that chronic deficits and debts will find their way into market pricing. One would have said that now for quite some time. When Don and I were serving together, the United States had $7 trillion in outstanding debt. And we talked and lamented the problems of that. We're at 33 billion at a time of full employment. I think some of the incremental move in yields in the 10-year that we talked about, which we see matched in the 30-year, is in part because some of that fiscal profligacy is now finding its way into the capital markets. So that's one variable. Two is, I think that there's an inflation risk premium in a new era of price instability for reasons we've talked about that are finding their way into the market. And from a more technical sense, I would say the Treasury Secretary and the Treasury have been doing all they can in the last several years to offset QT, which has now been operational for a year and a half. They've shortened the average duration of what they've issued, et cetera. They've tried to keep interest rate costs low. I think the ability to do that much longer is significantly impaired. So I think there will be more Treasury issuance in dollar terms. I think it'll necessarily be of higher duration as short-term yields have moved up. And so I think that there's a new flow that markets are just starting to anticipate. And as far as I can tell, the four biggest buyers of Treasury debt that had suppressed 10-year yields since Don and I were part of the creation of QE in 2008, the four biggest buyers are out of the market. And those four biggest buyers were largely price insensitive. The largest buyer was the Fed. I take Chairman Powell seriously that he's in QT for at least another year. So they're out. The Chinese, I don't think they're selling their stock of assets, but I have the strange impression they're not willing to do us any favors. They've got enough problems at home. They're out. Japan is actually booming. Japan is the great positive story we haven't talked about on this call. I think the idea that Japanese dollars are going to be flowing in as a large buyer of US Treasury securities is probably misplaced. Huge opportunities domestically. And fourth, the fourth relatively price insensitive buyer of treasuries for most of the last decade or two were banks and insurance companies. After all, the risk weighting that would come from the Basel Committee in the US suggests this was a risk-free asset until the banking crisis of last spring. So those four buyers are out. I think the 10-year Treasury yield is now as interesting a signal as anything since Alan Greenspan was chairman. You have a willing seller and willing buyers meeting at a price that isn't artificial, it's real. That's why I think those yields move up. And when the crisis that Desmond and Bill talk about hit, they move down sooner and they move down very quickly. But I think the next move is higher and probably materially so.
Yeah.
Do a flatter or even positively sloped Treasury curve. That's what you just said. Yeah.
Yes.
Any other thoughts on this, Bill?
Yeah, but I think the sequence of events deserves sort of thinking about. I suspect for all the reasons that Desmond has been concerned about the financial sector and Kevin has just said about the sort of secular elements that could lead to higher interest rates, that this could well lead to a financial crisis. And in that case, of course, the rates would reverse and they'd go back down again. But now we're in a situation where we've got a very, very slowly growing or depressed economy. And of course, as we know, something must be done. Well, if monetary policy is no longer effective because of the debt and all that stuff, private sector debt, then the answer is going to be fiscal expansion. But it's going to be fiscal expansion on the basis of the problem that we already have. And so it seems to me that we'll be moving into a kind of John Cochrane world, or much earlier on, a Sergeant Wallace world, where the government will be forced to finance themselves more and more through the central bank. And then we have the worry that people start saying, I know where this will end. And so you get a sudden moment of, as we've seen in the Latin American countries, where all of a sudden people say, I don't like it, and I'm out of here. Now, that may be quite a long way away, given particularly that the US is still the sort of the reserve currency of choice. But I really do think that people should be worrying about the possibility of this happening, because it seems to me that we're really, for the first time, people are starting to ask serious questions about the sustainability of government debt in major advanced economies. And that's really worrisome.
Well, we certainly had over the last decade, I think it'd be fair to say, with QE, a major financing of the government by the central bank. I think the Fed owned more than 20% of the outstanding treasuries, and isn't buying now, letting run off. But it was a huge move, and a huge move of monetization of the debt. Of course, as Don pointed out earlier in his remarks, we also monetized mortgage-backed securities, which is another whole different story. But in a way, when the Fed bought the mortgage-backed security, it meant the government had 100% of the risk of the mortgage, because Fannie Mae, which is the government, took the credit risk, and the Fed took the interest rate risk. And so the government had it all. So there we are. Listen, it leads very nicely into the next question we have from Doug Carr, which is this relationship between fiscal activity, fiscal actions, and the central bank actions. Doug wrote this: the Fed's balance sheet and interest rate response to the pandemic crisis, so 2020, 21-2, was proportionally comparable to its great financial crisis response, he writes, whereas the fiscal response was twice as large for the pandemic. Was this much more stimulative fiscal policy responsible for the inflation, he writes, and if so, can you handle inflation with only monetary policy? Right on this topic we're talking about. Debt deficit, central banks, Don?
Yeah, so I think I agree that the fiscal impulse, particularly in coming in the Biden administration right after they took office, was a major push to aggregate demand when supply was still somewhat constrained, and added to the inflation pressures. And it was disappointing that the Fed didn't take more active notice of this. I actually looked in the minutes through that period, that spring of 2021, to see whether there had been some discussion, and it was minimal. I mean, there was discussion of the fact that vaccination, so aggregate demand was bouncing back because vaccines were available and people were going out and shopping. And then you had this fiscal impulse on top of it. And what the minutes suggested was the Fed said, well, we've got this forward guidance in place. The forward guidance depends on how the economy evolves. If the economy evolves in a different way, that's kind of an automatically will react differently. And I think what they didn't recognize was how flawed the forward guidance was, which was to keep interest rates at zero until you got the full employment. And particularly if you get the full employment with a full head of steam, with both fiscal and monetary policy pushing in the same direction, I think I agree with, I think it was, I can't remember, Kevin, whoever was critical of the Fed's response to the fiscal thing. I just think they didn't take account of it sufficiently. But that doesn't mean that there's fiscal dominance. So it was certainly possible for the Federal Reserve to tighten earlier. Some of that inflation was the consequence of supply side shocks, et cetera. But a lot of it was too strong demand, particularly as manifest in the labor market. I think this is what we talked about a year ago. And they could have at least taken the edge off, made the peak inflation lower, got it down faster if they'd reacted earlier. And I hope that their re-examination of their framework begins with, what did we do wrong? Where did it go wrong? What are the lessons we can learn from this cycle? Now, I have a paper with Gowdy Egerton we produced for Brookings, which was pretty critical of the framework and especially the forward guidance. And I hope they examine those things. But that doesn't mean that given this fiscal policy, they couldn't have done a much better job on price stability.
Yep.
Thank you. And other thoughts on this, Desmond?
Yeah, I would agree with much of what Don said, but I think that it's important to remember the size of the stimulus that we were talking about. You know, we were talking about a $1.9 trillion stimulus coming on top of a $3 trillion stimulus under the Trump administration. So we're talking about 20% of GDP on the fiscal side being thrown at the economy, and the Fed is sitting there with interest rates at zero. You know, that is just inexcusable. You know, either the monetary policy was wrong before the fiscal stimulus, or it was wrong after the fiscal stimulus, but it can't be the same monetary policy with this kind of fiscal stimulus, you know. So I just don't get it, you know, that you've got both monetary policy and fiscal policy going in the same direction, and then we get surprised that we get a surge in inflation.
And $5.5 trillion in treasuries on the Fed's books.
I wonder whether, Alex, I wonder whether the Fed's vow of silence on fiscal policy is wise. I mean, it's certainly not something that Paul Volcker or Alan Greenspan or even Ben Bernanke. I mean, I think the Fed needs to point out the consequences of the fiscal policy. It would be better if it pointed out before the fiscal policy was enacted, but even after it's enacted, here's what you've done. Here's what's going to happen to interest rates are going to be higher than they otherwise would be because you've done this, et cetera. I think it would be the Federal Reserve, for all the problems that you guys have pointed out, is still a respected macro commentator. And I think it's just they should look at all the factors. So the stuff that Desmond talks about, foreign affairs, foreign developments, et cetera, financial stability, but also fiscal policy ought to be part of the discussion. And partly this is defensive. We don't muddle in your business, and we don't think you should muddle in our business. But I think it would help the economic conversation in the country if they at least talked about the consequences for monetary policy and the economy.
Thank you. Other thoughts on this one?
Alex,
Go ahead.
I didn't want to interject as Don was piling on with such brutal blows to the Federal Reserve, a 44-year veteran. So I was remaining silent. I share many of his sentiments, though, and like Don, think they should take them seriously. I'll only make 3 additional points. One is their vow of celibacy on the question of fiscal policy is convenient, but they didn't always practice that vow. In the darkest days of the crisis, and even after vaccines were produced, I seem to recall them encouraging massive fiscal expansion. So if you're going to obey the vow, you need to do it forever in all parts of the cycle. doing it from some moments but not others shows a dangerous asymmetry. Point one. Point two, the relatively red serious line between fiscal and monetary policy was blurred with the advent of quantitative easing. Now, when Don and I and Chairman Bernanke and Tim Geithner rolled that out, we promised that when the crisis was over, so too would this blurring be over. The truth is, it hasn't really ever ended from that moment till this. So we have to be adults on this, look this straight in the eye and say fiscal and monetary policy are blurred. The central bank does not want to be in the fiscal business. I take them very seriously and honestly about that vow, but they're in that business now. And it would be better if they got to the other side of it, which brings the third and final comment on inflation. I think I wouldn't describe myself as a pure monetarist either, but if Milton Friedman were with us today, I don't think he would still say that inflation is always and everywhere a monetary phenomenon, because he would see the blurring between fiscal and monetary policy. And I dare say, not to try to speculate as to his judgments, he would say inflation has something to do with fiscal policy now, especially because of de facto, if not de jure, monetization by the central bank, which kept interest rates low during the period between the crises, not just the period of the crises. And that's why I will say, as a final hope aspiration, the Fed seems quite pleased with the state of the economy, the no landing dots that we saw yesterday. They ought not wait 5 years for the kind of rigorous review that Don called on them to make. We can have 19 speakers between now and their meeting in the middle of December say they're uncertain whether they're going to raise rates next, or those 19 people could take Don's warning seriously and start to opine on these questions, start to frame the question, start to show some genuine interest. I think that's much more important than waiting with bated breath onto which side of the 100th decimal point the CPI number is that we're going to get before November, the PCE number is we're going to get at the end of September.
Why don't we take that up as we get down toward the end here? We're going to have a examination of reframing and lessons. Oh, I'm sorry, Bill. Go ahead.
I would just say what I think is sort of amusing, in a sense, is that people are going after the Fed because they got their inflation forecast wrong, so that inflation turned out to be much higher than the Fed had expected. Well, what I think is sort of amusing is that nobody over the course of the previous decades went after the Fed or the IMF or the OECD for a whole decade of saying inflation will rise towards the target and real growth next year will be stronger than it was this year. And for a whole decade, they got it wrong. And I guess the point that I want to make is there's something fundamentally wrong with the analytical framework. And that's one of the things that they should be really thinking about. And it goes back to the point I made before about the linear and deterministic. No, it isn't.
Yes, thank you. Go ahead, Desmond.
Yeah, I don't think that the Fed should be necessarily criticized for having got the forecast wrong. I think that the Fed should be criticized for having engaged in helicopter money, kind of facilitating what the government was doing, not offsetting it but just printing the money to make this possible, and I think Milton Friedman might have quite enjoyed seeing this experiment play out, that if you drop money, give everybody a payment check, and have the Fed finance it, you get some sort of economic response.
All right, now let me come back. If we were doing this re-examination of the framework, Kevin, in your comments, you talked about the not withdrawn idea of it's average 2% over some undefined period. And that would be one thing to examine. What would be on our list? And we have the fundamental question Bill has put on of the knowledge of the nature of this of the problem, the ontological problem. But what else would we put on our list that the Fed should be examining, changing in their framework, changing in their approach? What would you do instead of, Kevin? Let's come to the average. Well, on average over an undefined period. How would you change that?
Sure. So first off, I'd say, I think my experience is consistent with Don's. They have 27,000 incredibly talented people, and the people need to be encouraged that the business that they're set to do of ensuring price stability is doable, feasible, and within their power. So they need to be encouraged that inflation is a choice, and the choice is something the Fed will do. I think the broad reforms are a little too broad to be taken up here in the final minute, but I think they go across several categories. Reforms in communication. The one that comes to mind are these dot forecasts, which I think have way outstayed their usefulness, have constrained decision-making and made it harder for the Fed to call it as they see it, as they get anchored to forecasts, both intellectually and otherwise. Those forecasts also continue to mislead markets and I think lead to complacency. So in communications, that's first of a dozen things I'd suggest. On the broad strategy, they need to renounce the strategy they put forth in August of 2020. The strategy was, I think, inappropriate at conception and in implementation. The Fed is a proud and important organization. These are hardworking, smart, talented people. And like all of us, they make mistakes, and this was a mistake. They need to recant for it and replace it with a new framework. The new framework, I think, stays focused to the left of the decimal point on their objectives, not to the right of the decimal point. It focuses on ensuring price stability as the North Star, through which all these other objectives then inevitably follow. I think the price stability objectives then need to be clarified by not using the same stale data sets from the Department of Labor and the Department of Commerce that we've been using since these data sets were created in the late 1970s. The data needs to be much more contemporaneous. We need to get rid of these ideas of data dependence. The two problems with data dependence, as I've said before, is the data and the dependence. The data is wrong, subject to revision and backward looking. And dependence says we're solving for something that was of the past. So that overall strategy, I think, needs rigorous reform, and the Fed's fully capable of doing it. And finally, the other reforms be the role of the central bank in our system of government, the role and responsibilities of the Fed vis-a-vis Congress and vis-a-vis the Treasury. But let me stop there.
That was a brilliant extempore talk. Thank you. Other thoughts from anybody in the couple of minutes we got left on what would be on the list in addition to what Kevin has said, or if you agree with what Kevin said.
All right.
That's what, let me get Desmond, then we'll get done.
Yeah, just what I would add is that, I agree with what Kevin's saying, but what I'd add is that the Fed should also be focusing not simply on price inflation, but should have some consideration to asset price inflation, that they should be looking when asset prices get really totally out of whack. And that sets us up for a crisis that then puts in jeopardy, the price stability and the unemployment. So I don't think that they can totally disregard what goes on in the asset price market.
So I think the August 2020 announcement was that framework was tightly focused on what happened in the 20-teens and the difficulty getting inflation up the path. And it wasn't comprehensive. It was supposed to be a framework for monetary policy, but it was only a framework for a particular set of circumstances. So they need to broaden the examination out for different sets of circumstances when inflation is too high rather than just being too low. That there was a lot of asymmetries built into the 2020 framework. They weren't going to anticipate, they weren't going to be proactive against inflation because of the way they'd been burned what they thought they'd been burned over the 20-teens. The averaging was only one-sided, Kevin. It wasn't two-sided, but they never really explained that. So I think the whole thing needs to be broadened out into a more general framework that takes account of all these things. Among other things, they need to define maximum employment as the highest level of employment consistent with price stability, and get away from defining for various demographic groups and labor force participation and that kind of thing.
Thank you, Don. Bill, we're going to take you, and then we're going to go back and give Desmond, the leader of this excellent event, the last word. So, Bill.
Well, I think I would say that I agree with Desmond. I think that the financial problems that are associated with the conduct of monetary policy are great enough that central banks really ought to worry about leaning against the booms and busts, and they should use both monetary policy and macroprudential policy to do it. That does not mean that you forget about price stability. It just means that you define your price target or your inflation target over a longer time period that is currently fashionable. We simply don't know enough about how the economy works to get decimal point targets on inflation over a 2-year horizon. It's beyond our capacities.
Thank you. Desmond, you get the last word, except for my farewell to the audience.
No, the last word is I just want to thank the panelists for a great discussion, and I'd love to do this again next year and to see where this thing plays out. But I think I've made it clear enough that I'm not too optimistic about where we're headed.
Sounds great. Thank you all for a really brilliant and extremely well-informed discussion. Thank you. And to those of you who are with us by Zoom, thank you for participating.